Welcome to the Deep Dive, where we take a stack of sources and give you the high-conviction insights, bypassing all the noise. Our mission today is to really unpack the Q3 2025 earnings call for Dick's Sporting Goods, or DKS.
And this one is, it's pretty unique because we're not just looking at DKS anymore. This is their very first call as a combined company after the Foot Locker acquisition.
Exactly. And it is truly a tale of two vastly different companies running at the same time.
It really is. I mean, on one side, the core DKS business is just, well, it's firing on all cylinders. But then you have Foot Locker, and that presents this huge, immediate turnaround challenge.
A challenge they are tackling with some really aggressive and frankly very expensive actions.
And you have to understand that framing to get the results. DKS is deliberately taking, maximum financial pain right now in Q4 to clear the path for Foot Locker to actually be profitable by fiscal 2026.
They're taking the nuclear option on the cleanup.
That's a good way to put it.
So let's start with the big picture, the consolidated numbers, but yeah, keep that duality in mind. Consolidated net sales for the quarter, they just jumped 36.3% to $4.17 billion.
A huge jump. But of course, that includes the partial 8-week contribution from Foot Locker.
Right.
The real star of the show, though, is still the core DKS legacy business. Core comp sales were up 5.7%.
And that's not just a recovery number, is it?
Not at all. This is momentum building on momentum. That 5.7% is stacked right on top of a 4.3% increase from last year. So they've now had 7 straight quarters of over 4% comp growth.
That is just, that's incredibly rare in retail today.
It really is.
And all that core strength let them just barely edge out the bottom line. They delivered a non-GAAP EPS of $2.78, which was up from $2.75 a year ago.
And this is the critical part. Management is so confident in that core business, they actually raised the full-year outlook. They're now expecting core comp sales to grow between 3.5 and 4.0%.
Which is a big bump from their prior range of, 2 to 3.5%?
Exactly. And they raised core EPS guidance, too. It tells you everything you need to know. The legacy business is just marching forward, no matter the headache from the Foot Locker integration.
Okay, so let's talk about that headache. Foot Locker brought in $931 million in sales in that partial quarter.
Yep.
But it recorded a $46.3 million operating loss. And it was dilutive to the consolidated EPS by 52 cents.
That 52-cent number, that's the gut punch. Think about it. The Foot Locker acquisition, right now, it wiped out almost half of the core DKS business's quarterly profit gain.
And that was without the back-to-school season, which is usually profitable.
Right. And if you looked at the full quarter pro forma comps for Foot Locker, they were down 4.7%. North America was, not great, but okay, down 2.6%. But the international business was really weak, down 10.2%.
So let's focus on the success story for a minute, because that's what's propping all this up. What is driving the core DKS performance?
Well, it really just boils down to execution and customer experience. They're seeing a bump in both average ticket and transactions, so people are shopping more often and they're spending more when they do.
And they managed to expand margins, too.
They did, yeah. Gross margin expanded by 27 basis points, and that's powered by selling better quality products at better prices, so they don't have to rely on all those heavy markdowns.
And that strength is pretty broad-based, right? Across footwear, apparel, everything.
Footwear, apparel, hard lines. But the investment in their physical stores, that's where DKS is really setting itself apart.
The House of Sport concept.
Absolutely. Their real estate strategy is a powerhouse. They opened 13 new House of Sport locations just in Q3.
13. In one quarter.
The most they have ever opened in a single quarter. It brings the total to 35. And they're pouring money into them because they are just so productive.
Right. These are the huge stores with the climbing walls and batting cages. It's all about engagement. But they're not ignoring digital, are they?
Oh, far from it. Their e-commerce business is already a multi-billion-dollar operation, and it's still growing faster than the overall DKS business. And they're leaning hard into personalization.
So things like app-exclusive drops.
Exactly. App-exclusive reservations for launch culture sneakers or, personalized creative messaging for NFL fans. It's about turning a casual shopper into a real brand follower.
I also found their ancillary revenue streams really fascinating.
Right, like their investment in youth sports through Game Changer. But the biggest surprise for me was the Collectors Clubhouse.
Ah, the Fanatics partnership.
Yeah, they launched trading cards and memorabilia in 20 House of Sport locations, and apparently the response just blew away their expectations. It's a brilliant move.
It really is. It shows they get modern consumer culture.
Yeah.
Which brings us to the segment where that culture has maybe been lost. the Foot Locker turnaround.
Yeah, and management was incredibly frank about this. The CEO, Ed Stack, he was unambiguous. He said the business strayed from retail 101.
And the core issue was that a key brand, and we all know which one, pivoted to a direct-to-consumer model.
Right. They failed to react quickly enough.
So how does that leave Foot Locker with, quote, the wrong inventory?
It just creates this massive supply problem. When that key brand started pulling all the premium high-heat product for its own channels, Foot Locker was left with, well, the less desirable stuff. The clearance level, older stock.
So they were stuck with inventory nobody wanted at full price.
That is the definition of straying from retail 101. You don't have the fresh product your customer actually wants.
Which brings us to their strategy for fixing it. Clean out the garage. And the scale of this is just, it's genuinely shocking.
It is. They are flagging a future pre-tax charge of between $500 million and $750 million.
That's a massive, massive number.
Huge. And it's a mix of cash and non-cash charges. It's for devaluing all that bad inventory and for impairing underperforming stores.
This is the strategic nuclear option we talked about. And the pain from that is going to be felt right now in Q4.
Immediately. They expect Foot Locker's gross margins to just fall off a cliff, down between 1,000 and 1,500 basis points in Q4.
So for anyone listening, 1,000 basis points is 10%, so a 10 to 15% margin collapse.
Just for Foot Locker, yes. It's from all the aggressive markdowns and liquidating inventory, often through jobbers.
Can you just quickly define what a jobber is?
Sure. Jobbers are basically third-party wholesale liquidators. If Foot Locker can't sell that old product even at a deep discount, they sell it in bulk to jobbers for pennies on the dollar just to get it out of the system.
A sign of desperation, really.
It's a sign they just need to reset, and fast.
So despite this financial hit, they're bringing in new leadership. Ann Freeman, a former Nike exec, and Matthew Barnes, former CEO of Aldi.
That's key. It signals they're serious.
Yeah.
But even more important is vendor support. They were very explicit that all key vendor partners are fully aligned and ready to invest alongside them to reignite the brand.
And the timeline for all this. I know they ran an 11-store pilot that they said had encouraging results, but when does the full changeover happen?
This is where we all need to be realistic. They won't have full buying control until next year. They're targeting the real inflection point, when the shelves are clean and the fresh product is flowing, for the back-to-school season in 2026.
2026? Wow. That feels like a long time for the market to wait.
Are they still confident they can hit that goal of Foot Locker being accretive to EPS in fiscal 2026?
They strongly reiterated that confidence, and they stressed that their math for that target doesn't even rely on any stock buybacks. They believe the sheer scale of the cleanup today is what buys them that rapid recovery and margin expansion tomorrow.
So this massive integration raises a big question for investors. How is DKS protecting its own core momentum while fixing Foot Locker? Is there a risk of, distraction?
Management hit that one head on. They assured everyone they have, quote, ring-fenced the core DKS team.
So the people running the House of Sport rollout, the e-commerce growth, they're all protected from this distraction. Exactly. Their A team is still focused on the success story. And their confidence shows in the Q4 forecast for the core business. They only expect comps to slightly moderate.
Which is pretty strong considering they're going up against a massive 6.4% growth number from last year.
It is. Now, the confidence drivers for the Foot Locker turnaround itself are, they're twofold. First, there's operational certainty. They see this as a merchandising mistake, not a structural problem with the whole category, so it's fixable.
And the second driver?
The human element. This was, I thought, genuinely engaging. They talked about the excitement from the Foot Locker store staff, the stripers in blue shirts, who they described as being hungry for leadership and eager to play offense.
That detail really stood out to me, too.
It suggests the front lines are ready for this change, which is, that's half the battle in any retail turnaround. If your staff is demoralized, nothing gets done. If they're excited, leadership has fertile ground to work with.
All right, let's move into the fun zone. Based on this whole complex picture core strength, huge immediate pain, high conviction for 2026. What's the outrageous but plausible trade idea you've cooked up?
Okay, so the whole trade thesis is built around timing. DKS management is screaming from the rooftops that they are taking maximum pain now. The $500 million charge, the 1,500 basis point margin compression, all of it.
And the market doesn't like big short-term negative numbers.
Exactly. The market might overprice that short-term shock and potentially miss the certainty of what comes after. The guaranteed clean slate in 2026 and that accretion target.
So how do you play that difference between the short-term pain and the long-term conviction?
So bear with me here. We pitch a long-dated pairs trade. You sell short-dated, out-of-the-money puts, let's say expiring in Q1 of 2026.
Okay, so you're capitalizing on that known volatility and the guaranteed negative Q4 numbers.
Precisely. You take the significant premium you get from selling those puts, and you use it to fully fund long-dated calls expiring in, say, Q4 of 2026.
I see. So you're using the market's near-term fear to pay for the long-term potential.
You got it. You are betting squarely on that 2026 EPS accretion target being met or even exceeded once Foot Locker is clean and those $100 million in synergies finally materialize. It's a high conviction bet on management's own timeline.
That brings our deep dive on DKS to a close. And we walked away with, I think, two undeniable facts. Core DKS is executing at an extremely high level, and the Foot Locker turnaround is a costly but very clear high conviction plan.
And the final provocative question we'll leave you with is, well, it's a cultural one. The DKS success story is all about operational excellence in a suburban, family-centric, sport-led world. That's House of Sport. Management is betting that this exact expertise, this retail 101, can be seamlessly applied to the Foot Locker business, which is historically urban, trend-inspired, and much more sensitive to fashion. So the question is, does DKS have the cultural know-how to translate its suburban operational genius into leadership in a totally different, high fashion market segment? Or does that require a completely different playbook?
That is the challenge they have to answer between now and that 2026 inflection point. Thank you for joining us on this deep dive. And remember, the information discussed here is for educational and informational purposes only and should not be construed as financial advice. Always consult a licensed professional before making any investment decisions.